Hi there, welcome to the Ecofina Financial Channel. My name is Philip, and as usual, I'll be discussing one important economic event. Remember to click the subscribe button and set up the notification, but also so that you can get regular updates from this channel. Today, I'll be trying to answer one question which we know is on the mind of many people as they try to resolve or understand what really this is, and it's the matter of company valuation. Now, you must be wondering why a company like Tesla, which is relatively new, has a higher valuation than, for instance, a company like Ford, which has been around for ages, or higher than General Motors, or even Toyota. And that sometimes can be very confusing as to why such is possible, especially when you consider the fact that Tesla has only produced probably a few hundreds of thousands in cars. And on a yearly basis, these other car companies, Ford, GM, Toyota, and others produce millions of cars every year. But today we'll be looking at taking the spotlight on Nigeria, especially on the back of the announcement that Flutterwave, a payments company, a Fintech, financial technology company in Nigeria, is now valued at $3 billion. Yes, $3 billion. So the company recently raised $250 million. And with that, it's on the back of a valuation of $3 billion. Now, when we look at the biggest banks in Nigeria, so we look at Guaranty Trust Bank. So the valuation of Guaranty Trust Bank as we speak is $1.8 billion. In Naira, that's around 771 billion Naira. For Zenith Bank, it's around $2 billion. In Naira, it's around 848 billion Naira. Now, Flutterwave at $3 billion, and you convert that, is at 1.2 trillion Naira. So why does Flutterwave have a higher valuation than companies that are very well recognized, strong, reliable, have been there for many years and have done it and seen it all? And I think the simple answer would be that one valuation is based on optimism, while another valuation is based on reality. One valuation is based on growth potential, and another valuation is based on current realities. One valuation is based on financials that are not available to the public, while one, is assessed based on publicly available information. So with that, we take a little dive into how public companies and private companies are valued. Now, GTBank and Zenith Bank are publicly listed companies, while Flutterwave is a private company. So we'll now look at how a public company is valued and how a private company is valued, just to try and understand why there's a difference. For a public company, the shares are listed on the stock exchange, which means that it is traded frequently, almost on a daily basis. And when there's a frequent trading of a stock, it means that the price can easily be determined because it's just a function of demand and supply. If I believe that a company is worth much more than something, I will offer a higher price. So in the stock exchange, that happens. So people offer and pay for different stocks, which that way you're able to measure the price, the current price. So based on that, the public companies are always valued based on their market capitalization. So which is simply what is their stock price and what is the number of shares they have outstanding. So when you multiply the number, the stock price, the price of the stock at a particular time with the shares they have outstanding, you get the market capitalization, which is the value of that company. Now, you must have heard several times that when the company is trying to acquire another one, they will just offer a premium to be able to acquire it. So for instance, if a company shares, let's say GTBank, for instance, sells at 20 Naira, if a company wants to acquire GTBank, for instance, it would probably offer 25 Naira or 30 Naira or even higher to acquire each share. and that will be the value that they pay to acquire the company. But for a private company, it is different. Why? Because the shares are not publicly listed, and also their financials are not publicly available. If you want to check the financials of any of the public companies, you can even search online. You will get that very easily. But it's not the same case when it comes to private companies. Their financials are not publicly available. What it means is also that their valuation is not straightforward, neither is it very transparent, because it's just usually based on estimates and expectations. So how do you now value a private company? We'll just look at some examples and try and offer our opinion on some of them. So you have the comparable company analysis. Now, when you have a company which is private and you are looking to acquire them, if there is a comparable company, there's a company that does a similar line of business with that company, but it's publicly listed, you can use that insight into that publicly listed company to determine what the price of the private company would be. Of course, you have to adjust for some things like illiquidity. When something is not publicly traded, it means that the liquidity is not as high. Then marketability. So usually you put discount or premium on all of these things to get in value. But if you can establish a peer group and they are similar, probably in age, they are similar in size, then it could help. That is probably one of the best ways to evaluate a private company. But of course, you just never know. Even with what you can do is sometimes take an average of similar companies and then try and use it to estimate what that of a private company would be. And then there's also the enterprise value multiple, which is sometimes also used. That's usually, not to make it complex, it's just enterprise value, which includes the debt of the company, but removing the cash and cash equivalents divided by their earnings before interest, taxes, depreciation, and amortization. So that way, of course, you're able to capture the entire value of the company and then make some projections based on that. Of course, always adjusting for some variables. And then you also have the discounted cash flow method, which means you estimate the cash flow of the company. But one of the biggest challenges with this is that you have to estimate a terminal cash flow, one cash flow that you expect that, at a certain period, the company is going to be able to generate. And with that, you estimate the value of the company. But from what you can see is that it is not straightforward. It's based on estimates, it's based on assumptions. In fact, when we want to look at it critically, when a company is trying to invest, maybe venture capital companies or private equity companies are trying to invest in companies, they consider it usually that is more of an art than science, and usually base their investment decisions on things like, what's the number of users that this company has. So for instance, you look at Flutterwave, they will say, how many people are actually using Flutterwave? They have about 900,000 merchants. What's the potential for growth? Is there still the potential to onboard more customers? Are they able to go into new lines of business? What's the growth rate of the company? Is this sustainable into the future? Is the company gaining traction? And then they also look at what the management is like. Now, the challenge is that, yes, you can use all of these variables and come about a value. But the challenge is that, one, the management can change even at any time, even going into the future, no matter how hard you try to do that. And then you cannot also capture future impairments. Maybe that line of business becomes obsolete, or maybe there's also another technology which renders the one that is currently in use, is not as competitive as it used to be before. So anything can actually happen. And so even though private companies at the moment, financial technology companies, are getting a really high valuation, sometimes you cannot justify that value. especially when you compare it to traditional companies. And that's why some of those traditional companies are now considering probably the fintech companies they own. They can operate them separately and get a separate valuation for them, because since those fintech companies that are under their radar, do probably exactly the same thing as what these other companies are doing, they can as well make them separate from their business and then get a huge valuation based on that. So in essence, what we're saying is that Flutterwave valuation is based on estimates and is based a lot on what investors believe they could be in future. But what GTBank and Zenith Bank, the valuation of those companies is actually reality. It is what it is. And when you will try to look a bit deeper, you see that these companies have several assets. Okay, so if there's anything going wrong with the company, you know that they have some of the assets which can easily be disposed of. I'm not saying it's going to generate enough revenue for them to meet all their obligations, but they have serious assets because GTBank and Zenith have several branches all across the country. Or some believe, maybe brick and mortar might no longer be sustainable into the future. But when you look at even financial inclusion, there are still a lot of African cities or villages which are still yet to be reached, and which, of course, would probably still need those brick and mortar to embrace, because they want to be seeing what is actually happening to their money. So that is the way it is. So if you believe that Flutterwave is their valuation is highly justified, yes, you can let us know what your thoughts are. We will really appreciate what your thoughts are. Really, we've told you how a private company like Flutterwave is valued and why it's essentially different from GTBank and Zenith, which are publicly listed companies. But we would like to know what you think about this the valuation of both of these companies. Do you think is justified? Do you think the future holds that much promise for a company like Flutterwave? And what do you think about GTBank and Zenith Bank as well? Let us know your thoughts in the comment section. And if you have questions, we'll be glad to attend to them. And we'll be back with you next time. Remember to click the subscribe button and like this video if you found it informative, so that others can also get to see it. And we'll be back with you next time.